Hello, welcome to Any Answers Answered. This month we've got two questions as usual to have a look at. This time we're going to talk about stamp duty, which is not something we normally talk about. The question itself, with the greatest of respect to the questioner, is not something I want to go into huge detail on because it's so specific. It's a situation where somebody's living in a house, they're going to buy another house, they're going to live in that for a bit, they're going to rent it out, they're going to buy another house that they might live in, etc, etc, etc. We're talking 3% stamp duty, the surcharge, the extra element to stamp duty these days for second homes. And there is quite a lot of confusion about this because there is this exemption if it is the house that you're living in.
Yeah, and the question actually is quite an interesting one in its particulars because, and it's not that unusual, it involves a chain of property transactions. And the question is whether, as a result of transactions in that chain, the individual can recover the 3% additional SDLT that they had to pay when purchasing a second property. Now, the basic rule is that if at the end of transaction day, and that's the day on which you complete the purchase of a residence, you have an interest in more than one residential property, then you're in for the 3%. But there are a number of necessary and sensible exceptions to that rule. And the main exception will be if what you're doing is replacing your main residence, which is sold. And the main residence is determined factually, so it's not identified in precisely the same way as it might be for capital gains tax, where of course you can nominate which of two or more residents is your main residence for capital gains tax purposes. Here it'll be a question of fact. But in the vast majority of cases, individuals are buying and selling their homes, and that's it. So and they don't have more than one property at any one time. If you've got a bridging problem, so the taxpayer lives in their current home, decides to buy their new one, and is unable to synchronise the transactions, at the end of transaction day, they've got the interest in the new home and the interest in their old home, which is still on the market, and they hope to be able to sell, and maybe they've got bridging finance. Well, they won't have, well, I'll start again. They will have to pay the 3% initially, but as soon as they dispose of the first home, they can recover that 3%, as long as they do so within 36 months.
Okay, so that is exactly what happened to me. We predate the 3% charge.
Yeah, of course.
But we were in a position where we bought our new house whilst the old house was on the market. So at midnight on that day, as we'd moved in, we had completed, everything was done, we'd locked up the old house, we would have to pay the 3%, but I think we sold 3-4 months later, we sold the old house. At that point, we could then request to reclaim the 3% because it's disposed of within the 3 years.
And I'd hope that you would remember that, because it would have been, let's suppose you were buying a new house for $500,000, 3% of $500,000 is 15,000. That would have hurt and would need to be financed as part of the bridging finance. The time limit, by the way, for claiming the refund is the later of a year after the notification date for the transaction that's prompted the 3%, and that would be 30 days after completion. So it's a year after that 30-day date, but it's the later of that or 3 months after the sale that enables you then to make the reclaim. Now that's going to be important where the bridging period goes beyond a year or so after the purchase of the second property, because you could imagine that there's a bridging period of maybe 2.5 years. Eventually you sell the first home, and at that point you're able then to recover the 3% on the second home, but only if you make the claim within 3 months of that later sale. And although conveyancing solicitors should by now be very on top of do we or don't we have to pay the 3%, I suspect they won't be quite so on top of if they're acting for a vendor rather than a purchaser, they won't quite be on top of, oh, are we in a position to reclaim an earlier paid 3%? Because if so, we've got to file the claim for that within 3 months.
Now, if I then go on to buy another property, then at midnight on that particular day, I've bought another property. I'm obviously not living in it because the facts tell me I'm living in the house that I do live in.
Yep.
Then that's another 3%.
3%.
Very straightforward indeed.
Yep.
If I then decide to move into that house and sell the other one, then at that point, there is no additional stamp duty to pay. But the next house I buy, we're back to the same test again. Midnight on the day, we look at how many houses we have. Do we need to pay it or not? Simple as that.
If you're not replacing your main home, which is sold, you will have to pay it.
Absolutely.
Yeah.
And even if you are, if you still own the old one, there is still
Because
a
we haven't
3%
sold it.
charge.
That's right.
Yeah.
And there are a number of iniquities in this. And here's a case that was referred to me by one of our delegates in Bristol. Her son has inherited a 2-bedroom terraced house from his grandmother, and that has got tenants in it. And the son is living in London in rented accommodation. Now, she's thinking about helping him buy his first home in London and wanted to know whether he'd have to pay the 3%. Well, if in, say, 6 months' time, he completes the purchase on his first home, moving out of his rented accommodation, but he's still got the tenanted house in Bristol, at the end of transaction day, he has an interest in more than one residence, and he is not replacing his main residence, which is sold. Because if you're living in rented accommodation, that's your main residence and you're not selling it. And therefore, he would have to pay the 3%. Whereas, and it's totally unfair, if that boy was already living in London in a flat that he had bought a couple of years ago, and he inherited the house from his grandma and that's now tenanted, and then he moves in London from old flat to new flat, he wouldn't have to pay the 3% because he gets the exemption. Crazy.
But hopefully useful that we have been able to, I hope, explain that 3% rule and how it applies. The key is the midnight on the day when you acquire another property, and we have to consider it. Our second question this time, it's a relatively straightforward question, but it's getting an awful lot of confusion up and down the country. We're coming across a lot of confusion. You can still, if you are incorporating a business, take the goodwill value within the unincorporated business and sell it to, transfer it to, sell it to, whatever you want to do, the newly formed company. But the two things that have changed that are now restricting why people think you can't do it at all. Number one is amortization is no longer available in the company. And number two, entrepreneurs relief is unlikely to be available on the transfer of the goodwill from the individual or partnership across to the company. But you still can transfer goodwill?
Oh yes, and the question in any answers related to the sale of goodwill to a limited company for I think just £6,000. So we weren't looking at a significant figure, but it does raise, as you say, the more general question as to where are we with incorporation. Since December 14, entrepreneurs relief not available in a case like that where you are transferring goodwill to a connected person. Slightly relaxed now in the Finance Act 2016, but in a simple case like this, where a sole trader transfers the business to a limited company, all right, they're not going to qualify for 10% under entrepreneurs relief. But don't forget that the capital gain would first qualify for the annual exemption, so 11,000 at the moment, or is it 11,100, sorry, and that would cover in this any answers question the 6,000 we're talking about, but any gain in excess of that would only be taxed at 10% if you're a basic rate taxpayer, and only at 20%, courtesy of Osborne's reduction in capital gains tax rates, if you're a higher or top rate taxpayer. So you are still able to get the goodwill into the company, albeit at perhaps 20% tax, well that is the maximum tax rate now, and then of course you credit the value of the goodwill to director's loan account, and that then enables you to extract future profit from the company tax and NI free, with those profits only subject to 20%, but going down in 3 years' time or 3.5 years' time to 17% in the company. So there are still tax advantages in doing that, and that's disregarding the other point you made, which is that amortisation is not allowed any longer since, was it July 15, where the goodwill has been acquired from a connected person. In any event, for many older sole traders and partners, amortisation wasn't allowed under the pre-April 2002 anti-avoidance rule. Okay, for younger ones, they were getting that double benefit of entrepreneurs' relief and amortisation. Now they get none. But as I've said, it could still be advantageous to do that. So I don't think we should completely dismiss the idea of tax-motivated incorporation.
And one thing you didn't mention there, but I think is important, if the money has gone across from the sole trader into the company under the guise of goodwill, a loan account now exists. That loan account is effectively the working capital of the business, and so some interest could quite reasonably be paid on that, I think, by the company to the individual. And with personal savings allowance and all that sort of thing happening out there, the opportunity is certainly there to take money out
very
efficiently.
much so. In certainly lower level cases, the idea of using not just the new personal savings allowance of £1,000 for basic rate taxpayers, but also the savings rate band of 0% on the first 5,000 of interest means that if we can justify it commercially, the director's account should carry interest that will generate, let's say, £6,000 a year, because if you were then, from the company, to draw 11,000 of salary covered by the personal allowance, 6,000 of interest would be covered by the savings rate band and the personal savings allowance, and then on top of that, you could have another, what have I got up to, 11 plus 6 is 17, so another 26,000 of dividends, I'm assuming the company is making enough profit, will keep you within basic rate band, and the 26,000 dividends, well, the first 5,000 would be covered by the 0%, you would only have to pay tax of 7.5% of 21,000. So a very, very low tax rate, whereas the sole trader making 43 grand a year, actually pre-corporation tax would be a bit more than that, would have a lot more tax to pay. So sole traders in the sort of 40, 50,000, but the big question is whether you could justify a goodwill valuation that would get the director's account up to a level that would justify 6,000 of interest.
Yes.
You know, we can play around with the numbers, but let's not forget the commerciality of it all.
And I think that's important. Whilst we can confirm to the questioner that goodwill very definitely still can be transferred across to a company, the original problem has always been and remains, can we successfully argue that the goodwill is justified in the first place in terms of the valuation that has been put on it? That is the end of Any Answers Answered for this particular month. Do get in touch via Accounting Web. Do post your questions on Any Answers, and perhaps next month we will answer your question. But for this month, bye-bye.